Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? Hope you're having a great day here. We're financial advisors, and we just use this sort of time to teach you something new, help you, motivate you, work with your personal finances, whatever it may be, retirement investments included, of course. And we spend a lot of time doing this with our customers. We do a class every single week to teach our customers something more in detailed, focused, answer questions they may have, so you can help get your net worth growing. Make the right decisions along the way so you don't have to go back in time and say, damn, I wish I'd have known that, right? So we help you guys with all of that. So hope you'll check us out at jazzwealth.com. Today I want to give you a little bit of a warning about past performance. I see a lot of people kind of focused on the short term in terms of performance. They're picking funds in their 401k or wherever you may have your different retirement accounts. They're picking things based on current performance. It's a little bit tough. Bill Gates was actually quoted as saying, people tend to overestimate what they can do in 1 year, but they underestimate what they can do in 10 years. And I heard this quote a long time ago, and it just sort of like left me. I never thought anything of it. But when it comes to performance, your finances, retirement, getting your dough straight, right? A lot of us try to get excited about 1 year's worth of time period and say, I'm going to pay that debt off. I'm going to save a bunch of money. I'm going to buy 3 apartment complexes, right? At 1 year, right, everything takes a little longer than you expect. So I want you to really think in bigger terms, in longer terms, as far as your finances go. One of the things that financial advisors like to sort of say, and we'll go over to the chart here, a lot of people, they use the big fancy words. Look, you could tell, like some of you give me grief for wearing a weird looking shirt or the softball shirts and stuff. I do that because I want you to know that I'm going to treat you the same. Like, I'm not going to pretend to be suit and tie guy and use big words and everything. People don't fall for that anymore, right? You don't fall for that. Anyways, one of the big things that people, financial advisors like to talk about is what stage of your life are you in? Accumulation phase or the distribution phase? This is just a fancy way of saying, are you supposed to be building your net worth now, or are you supposed to be protecting your net worth, okay? So here's what I want you to do. When you're looking at anything that you're investing in for retirement, I'm going to use that as an example today. If you're investing for retirement and you're younger, 30s, 40s, early 50s, right? That's young. If you're in that age group, I want you to think, I'm in the accumulation phase. But what does that mean? Let me tell you. Here's what I want you to think. I want you to think, gimme, 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 right? I want you to picture Warren Buffett going, gimme, 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 right? Because what happens? When the markets fall, you want to gobble that up. Take as much of it as you can. When the markets fall, Warren Buffett goes quiet. You notice how he's never on TV when the markets are weak? He's not scared. He's shopping. He's out there looking for things to buy. So when you're in the accumulation phase, I want you to remember me going, gimme, 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 right? And when the markets fall, you take that. Get every last bit of it you can. How many times has the market fallen and you've said, wow, I wish I would have bought that. I missed it, right? The economy gets weak, the stock market falls, and you see it falling, you get a little nervous. It's understandable. But now that we're past all of it, you look back and go, shoot, man, imagine if I would have bought it then. So when you're in the accumulation phase, I want you to think that way. Gobble every little discount up that you can get. I happen to be 30, am I 36? I'm 36 or 37 at the moment. And when the markets fall, I salivate. I get excited. I do extra classes for our customers because I want them to get excited about it. And you know what happened? The last time the stock market fell between October, November, and December, go look at a chart. The markets fell almost 20%, or a little over 20%. Every one of our customers was excited about that. I only had one customer actually that said, thanks, Dustin, but I'm going to go buy gold, physical gold. They just believed in it. I said, well, you know, that's great. They're looking pretty good now, but they're going to regret that in the long term. Everybody else, you know what the most common email I got from customers and phone calls I got was? Hey, Dustin, the deposit hit my account today. Can you get it invested today? What are you doing, man? Where are you at? Can you invest that money? Because they saw the markets falling and they were worried they were going to miss a discount. Did you respond that way? Do you know that $40 billion came out of 401k funds in December alone? What was that? That wasn't people retiring. That was people panicking and saying, move me to cash. I don't like what the markets are doing. If you're in the accumulation phase, you think, gimme, 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 gimme. When the markets fall, you get excited about it. How often has the markets fallen and never recovered? It doesn't happen, right? I joke about it with the little towel that I have, but every time it recovers. It's just a matter of time. So you buy those discounts if you're in the accumulation phase. All right. If you're in the distribution phase of your life, well, you're pretty much retired. You're a year or two away, you're in retirement, you're deep into retirement, and you're in the distribution phase of your life. Now we're thinking protection. We're no longer saying, gimme, 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 gimme. We're thinking, how do I protect what I have and stretch it as far as I can possibly stretch it out, right? I do a lot of videos where I talk about having certain incomes in retirement. And I get a lot of grief for those videos because people don't realize that when you retire, your money doesn't stop growing. You're not just going to draw from a flat balance the rest of your life. It's going to grow. But now it's important. In the distribution phase of your life, we're thinking, okay, less growth. That's okay. We're going to get a little less growth because we don't want to be as aggressive. But we want to stretch those dollars out as long as possible. Work with the person that's handling your account, or do some homework if you're the one that's doing it, and find a way to stretch that money out. I want to know exactly how many dollars you will have every single year of your life. And then we just have to kind of guess when you think you might pass on, but we can stretch it out and play with those numbers, okay? So distribution point of your life, think protection. Accumulation points in your life, you think gimme, 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 right? I want you to say that. Go every time the markets fall, I want to hear you guys say that. I want to see the posts on that, okay? All right. As far as the investments go, please don't focus on the short term, right? What happens, and this is sort of misleading, it's on our site too, I hate how we do this, but if you were to get, I don't even give the short-term performance on our, as for our portfolios. I don't like that. I don't want people getting excited about something that may not actually be factual. It's not that we're lying. It's not that mutual funds are lying. It's not that all the different funds that you may be wanting to buy are lying. But what happens is, here, I'm going to go to the chart and show you this. Here's what happens. If you look at like a 6 month, this isn't normal. You don't normally see 6 months. But if you see a 6 month return, it's 6 months from the date of that report. If you were to go 6 months back from now, every one of these funds should be performing really well. We look like heroes here at Jazz Wealth for the last 6 months. It's not fair, right? I didn't do anything special. The markets helped us out, and I put you in the right position. That's all it is, right? So you might get excited because you see something like 22% in the last 6 months. Is that really how things go? I need you to look further, right? If you go a year out, whoa, what a difference. If you were to look at a fund from 6 months to 1 year, you may see something like this. You go, what happened? I thought this was a great fund. It said 22%. Now I'm seeing 8. You know why that happened? Very common question that I get a lot of people. You're checking your 401ks and you're disappointed. Here's what's happened. The market did this, went from October to December, did this. January, February, March, April, May, June, did this. Essentially, that's what happened. So if you invested here, you got a little gain. If you invested here, you got an even smaller gain. If you invested here, good for you. You got a pretty decent gain. But there's so many moments in time over the last year where you could have invested and not really seen such a big return, right? I need you to go out 5 years. 3 years is sort of okay. It's nice to see, but I need you to go out 5 years or further, right? Think of the Bill Gates comment. Nothing's going to get accomplished in 1 year as expected. Everything can be accomplished in a 10-year period given that you're positioned in the right way. Now, one last thing I want to give you, and then I'm going to get out of your way, volatility. When you're looking at those returns, 1 year, 3 year, 5 year, whatever you look at, when you look at those returns, I want you to look at the volatility of those returns as well. So here, give you a quick, silly, very, very crude example here. But if fund number 1 returns 20%, I don't know, let's just say for some reason it's 20% over the last 3 years. That's pretty high. But let's say that that's the case. And day by day, your account is fluctuating like this. Maybe not day by day, but over the years, your account has wild swings to get 20%. Most of you could probably handle that. Big deal, you know it'll recover, everything's fine. But if you can get the same 20% for fluctuations like this, wouldn't you choose that? It's a lot easier, right? That's like saying, would you rather drive over a very, very, very bumpy road and you'll get there maybe a touch faster? Or would you rather take the scenic route? Get there basically at the same time, but it's a nice smooth road. We're going to choose the smooth road every time. We don't mind a bumpy road, but if we have a choice, geez, let's take the smooth road, right? Let's have a good time. So I want you to not only look at performance in the long term, but I want you to look at long-term volatility. What sort of back and forth can you expect? And it's got to fit what you're looking for. If you can handle volatility and it's going to generate 30%, I'll take the volatility. I know everything will be fine. I'll go with more volatility. But if you're seeing about the same performance, go with less volatility. We focus on that so much here at Jazz Wealth. For our portfolios that are on our website, we have a goal. Each one of them, we've listed the goal, the objective of the fund. But now day to day, we try to squeeze that volatility. I want my customers to see the least amount of back and forth as possible. Now, if you're investing aggressively, that's pretty difficult. We can sort of squeeze a little bit. But for those of you that are conservative, close to retirement, it's super important that you don't stress in retirement about large fluctuations in your account. Anyways, just wanted to cover that for you. I hope you have a great day. Later, we'll be back at 5 o'clock Eastern to do the closing beat. It's just a quick live stock market update show. We'll cover everything that happened in the markets today. I hope you'll join us. Thank you for watching. See you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.